Good morning, everybody. Welcome to TrendSpider Live. My name is Mike, and today is going to be a very crazy day because we have Mr. Powell about to speak at the Jackson Hole Symposium in about like 4 minutes right now. So welcome, everybody. If you're out there in the chat, please say what's up and say how your morning is going. I just pulled up the SPY right here on my chart on the 5-minute, and it looks like we're off to a solid start. Let me pull up the daily chart. See this 21-day EMA on my chart that we just bounced off here on the daily. So we're starting off pretty good, but we'll see how the market reacts when Powell gets up to the stage. We'll be trying to find it to stream it for us. It is nice and bright and early here in the morning. Yes, from LA. So it is also 7 in the morning for you. Welcome. Al, what's up? Thank you for joining in. What are you guys looking at today? I will be looking at obviously the main indices, and I'll also be watching TLT pretty closely here. And then also I wanted to show you guys something as well. I wanted to plot the last 5 Jackson Hole meetings onto a SPY chart. And an easy way to do that is using TrendSpider's new Sidekick AI. All we're going to do is just type this, plot the last 5 Jackson Hole Fed speeches on my current SPY chart, press enter there, and just give it a second. And then we're going to have some arrows on our chart pointing to where the last Fed or Jackson Hole speeches were. So that will be fun to kind of analyze what happened in the last, few meetings as we wait for this one to start. Let's see. So we got like 2 minutes until it comes on. It's going to be Mr. Powell's last one. Here we go. We haven't plotted on our chart now. As you can see, 2024 actually kind of marked basically the top there. It's always around this August, 22nd, 23rd time, around the same date. So you see in 2023 it was there. So in 2024 here, thanks to Sidekick, let's see, did it say anything else? Yeah, at 562. Notice how SPY has generally trended higher over the last Jackson Hole events, temporary setbacks. I don't know. This one looks like it definitely marked the top here in 2024, though. Obviously, this one is today, so it should be very interesting to see what happens. What do you guys think is going to happen? I'm pretty hyped to see Powell's last speech here. We'll see if he does anything crazy. Him and Trump don't really get along very well, so who knows how that is going to go. I don't know what's going to happen, David. It's going to be interesting, though. Rate rise, that would be crazy. Yeah, if I go ahead and pull up the poly market odds, definitely going to keep this open most likely. See how it reacts during the speech. Oh, yeah, the chances of a rate cut right now, you guys, are decreasing pretty good. Dropped down to 60%. It was previously at like 70%. Just about a week ago. Yeah, it's the last speech of his term because his term ends in May of next year, I believe. So, and all these Jackson Hole speeches are in August. So yeah, will be his last one for Powell. So we'll see if he goes out on a bang or what happens. I'm going to be looking for this speech here, seeing if I can find it and get it streamed live for us. Let me see. I think I have the right stream open. There's a lot of people tuning into this one. But it just struck 7 a.m. And I don't see this one going live. But let's see in the meantime if we can ask Sidekick anything else about these. I'm going to ask Sidekick which parts of the market are generally the most sensitive to the Fed chair speeches at Jackson Hole and why. Just so we can see maybe there's something out there that we're not seeing that other people are. Let's go back here to the 15-minute. Wow, the market is absolutely ripping right now, you guys. Absolutely ripping. Wow, this is insane. Let me hit the 5-minute. This is crazy. What percent move is that? It's almost a 1% move on SPY there, you guys. 0.84, 0.89 basically. Right as the speech was supposed to be starting. I don't see it starting yet. But wow, what a rip. What a rip on the SPY. Let's see what else is going on. Let's open QQQ. Let's see how big the QQQ move was. QQQ moved just a little bit higher up, about 1%. It did hit that 1%. Check the small caps. Check IWM out. Wow, IWM almost jumped 2% right there. 1.8% on the small cap ETF IWM. Wow. Insane move. Absolutely insane moves. Let's check out some of the big ones like NVIDIA. About 1.5% move up on NVIDIA. Let's see something like Palantir. Looks like Palantir is just going up to yesterday's high, though, but it did move up 2.5%. Some insane moves going on right now, you guys. Let's go back to the SPY and see what's going on. Wow. Wow, wow, wow. That was insane. Let's see if it holds. Regardless, that is an awesome move for anyone that's long right now. If you guys are in calls or anything like that, you guys probably just absolutely printed. Is there anyone out there in some trades right now? Yes.
Has come down a great deal
Okay.
from its post-pandemic highs.
Powell
At
just
the
came
same
up
time, the
live.
balance
I
of
put him
risks
up on
appears
the
to be
screen. Let me
shifting.
know if y'all can hear him.
In my remarks today, I will first address the current economic situation and the near-term outlook for monetary policy. I will then turn to the results of our second public review of our monetary policy framework,
Awesome.
as captured in the revised Statement on Longer Run
I
Goals
will
and
be
Monetary
quiet.
Policy Strategy that we released today. When I appeared at this podium 1 year ago, the economy was at an inflection point. Our policy rate had stood at 5.25% to 5.5% for more than a year. That restrictive policy stance was appropriate to help bring down inflation and to foster a sustainable balance between aggregate demand and supply. Inflation had moved much closer to our objective, and the labor market had cooled from its formerly overheated state. Upside risks to inflation had diminished, but the unemployment rate had increased by almost a full percentage point, a development that historically has not occurred outside of recessions. Over the subsequent 3 Federal Open Market Committee meetings, we recalibrated our policy stance, setting the stage for the labor market to remain in balance near maximum employment over the past year. This year, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. Tighter immigration policy has led to an abrupt slowdown in labor force growth. Over the longer run, changes in tax, spending, and regulatory policies may also have important implications for economic growth and productivity. There is significant uncertainty about where all of these policies will eventually settle and what their lasting effects on the economy will be. Changes in trade and immigration policies are affecting both demand and supply. In this environment, distinguishing cyclical developments from trend or structural developments is difficult. This distinction is critical because monetary policy can work to stabilize cyclical fluctuations, but can do little to alter structural changes. The labor market is a case in point. The July employment report, released earlier this month, showed that payroll job growth slowed to an average pace of only 35,000 per month over the past 3 months, down from 168,000 per month during 2024. This slowdown is much larger than assessed just a month ago, as the earlier figures for May and June were revised down substantially. But it does not appear that the slowdown in job growth has opened up a large margin of slack in the labor market, an outcome we want to avoid. The unemployment rate, while edging up in July, stands at a historically low level of 4.2% and has been broadly stable over the past year. Other indicators of labor market conditions are also little changed or have softened only modestly, including quits, layoffs, the ratio of vacancies to unemployment, and nominal wage growth. Labor supply has softened in line with demand, sharply lowering the break-even rate of job creation needed to hold the unemployment rate constant. Indeed, labor force growth has slowed considerably this year with the sharp fall off in immigration, and the labor force participation rate has edged down in recent months. Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. At the same time, GDP growth has slowed notably in the first half of this year to a pace of 1.2%, roughly half the 2.5% pace in 2024. The decline in growth has largely reflected a slowdown in consumer spending. As with the labor market, some of the slowing in GDP likely reflects slower growth of supply or potential output. Turning to inflation, higher tariffs have begun to push up prices in some categories of goods. Estimates based on the latest available data indicate that total PCE prices rose 2.6% over the 12 months ending in July. Excluding the volatile food and energy categories, core PCE prices rose 2.9%, above their level of a year ago. Within core, prices of goods increased 1.1% over the past 12 months, a notable shift from the modest decline seen over the course of 2024. In contrast, housing services inflation remains on a downward trend, and non-housing services inflation is still running at a level a bit above what has been historically consistent with a 2% inflation. The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about both timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem. A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Of course, one time does not mean all at once. It will continue to take time for tariff increases to work their way through supply chains and distribution networks. Moreover, tariff rates continue to evolve, potentially prolonging the adjustment process. It's also possible, however, that the upward pressure on prices from tariffs could spur a more lasting inflation dynamic, and that is a risk to be assessed and managed. One possibility is that workers who see their real incomes decline because of higher prices demand and get higher wages from employers, setting off adverse wage price dynamics. Given that the labor market is not particularly tight and faces increasing downside risks, that outcome does not seem likely. Another possibility is that inflation expectations could move up, dragging actual inflation with them. Inflation has been above our target for more than 4 years and remains a prominent concern for households and businesses. Measures of longer-term inflation expectations, however, as reflected in market and survey-based measures, appear to remain well anchored and consistent with our longer-run inflation objective of 2%. Of course, we cannot take the stability of inflation expectations for granted. Come what may, we will not allow a one-time increase in the price level to become an ongoing inflation problem. So, putting the pieces together, what are the implications for monetary policy? In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. Our policy rate is now 100 basis points closer to neutral than it was a year ago, and the stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Monetary policy is not on a preset course. FOMC members will make these decisions based solely on their assessment of the data and its implications for the economic outlook and the balance of risks. We will never deviate from that approach. So, turning then to my second topic. Our monetary policy framework is built on the unchanging foundation of our mandate from Congress to foster maximum employment and stable prices for the American people.
He's basically confirming rate
We
cuts.
remain fully committed to fulfilling our statutory mandate, and the revisions to our framework will support that mission across a broad range of economic conditions. Our revised statement on longer run goals and monetary policy strategy, which we refer to as our consensus statement to save time, describes how we pursue our dual mandate goals. It is designed to give the public a clear sense of how we think about monetary policy, and that understanding is important both for transparency and accountability, and for making monetary policy more effective. The changes we made in this review are a natural progression grounded in our ever-evolving understanding of our economy. We continue to build upon the initial consensus statement adopted in 2012 under Chairman Ben Bernanke's leadership. Today's revised statement is the outcome of the second public review of our framework, which we conduct at 5-year intervals. This year's review included 3 elements: Fed Listens events at reserve banks around the country, a flagship research conference, and policymaker discussions and deliberations supported by staff analysis at a series of FOMC meetings. In approaching this year's review, a key objective has been to make sure that our framework is suitable across a broad range of economic conditions. At the same time, the framework needs to evolve with changes in the structure of the economy and our understanding of those changes. The Great Depression presented different challenges from those of the Great Inflation and the Great Moderation, which in turn are different from the ones we face today. At the time of the last review, we were living in a new normal, characterized by the proximity of interest rates to the effective lower bound, or ELB, along with low growth, low inflation, and a very flat Phillips curve, meaning that inflation was not very responsive to slack in the economy. To me, a statistic that captures that era is that our policy rate was stuck at the ELB for 7 long years following the onset of the global financial crisis in late 2008. Many here will recall the sluggish growth and painfully slow recovery of that era. It appeared highly likely that if the economy experienced even a mild downturn, our policy rate would be back at the ELB very quickly, probably for another extended period. Inflation and inflation expectations could then decline in a weak economy, raising real interest rates as nominal rates were pinned near zero. Higher real rates would further weigh on job growth and reinforce the downward pressure on inflation and inflation expectations, triggering an adverse dynamic. The economic conditions that brought the policy rate to the ELB and drove the 2020 framework changes were thought to be rooted in slow-moving global factors that would persist for an extended period. And they might well have done so, if not for the pandemic. The 2020 consensus statement included several features that addressed the ELB-related risks that had become increasingly prominent over the preceding 2 decades. We emphasized the importance of anchored inflation, longer-term inflation expectations, to support both our price stability and maximum employment goals. Drawing on an extensive literature on strategies to mitigate risks associated with the ELB, we adopted flexible average inflation targeting, a makeup strategy to ensure that inflation expectations would remain well anchored, even with the ELB constraint. In particular, we said that following periods when inflation had been running persistently above 2%, appropriate monetary policy would likely aim to achieve inflation moderately above 2% for some time. In the event, rather than low inflation in the ELB, the post-pandemic reopening brought the highest inflation in 40 years to economies around the world. Like most other central banks and private sector analysts, through year-end 2021, we thought that inflation would subside fairly quickly without a sharp tightening in our policy stance, as this slide will show. When it became clear this was not the case, we responded forcefully, raising our policy rate by 5.25 percentage points over 16 months. That action, combined with the unwinding of pandemic supply disruptions, contributed to inflation moving much closer to our target without the painful rise in unemployment that has accompanied previous efforts to counter high inflation. This year's review considered how economic conditions have evolved over the past 5 years. During this period, we saw that the inflation situation can change rapidly in the face of large shocks. In addition, interest rates are now substantially higher than was the case during the era between the global financial crisis and the pandemic. With inflation above target, our policy rate is restrictive, modestly so in my view. We cannot say for certain where rates will settle out over the longer run, but their neutral rate may now be higher than during the 2010s, reflecting changes in productivity, demographics, fiscal policy, and other factors that affect the balance between saving and investment. During the review, we discussed how the 2020 statement's focus on the ELB may have complicated communications about our response to high inflation. We concluded that the emphasis on an overly specific set of economic conditions may have led to some confusion, and as a result, we made several important changes to the consensus statement to reflect that insight. First, we removed language indicating that the ELB was a defining feature of the economic landscape. Instead, we noted that our monetary policy strategy is designed to promote maximum employment and stable prices across a broad range of economic conditions. The difficulty of operating near the ELB remains a potential concern, but it is not our primary focus. The revised statement reiterates that the committee is prepared to use its full range of tools to achieve its maximum employment and price stability goals, particularly if the federal funds rate is constrained by the ELB. Second, we returned to a framework of flexible inflation targeting and eliminated the makeup strategy. As it turned out, the idea of an intentional moderate inflation overshoot had proved irrelevant. There was nothing intentional or moderate about the inflation that arrived a few months after we announced our 2020 changes to the consensus statement, as I acknowledged publicly in 2021. Well-anchored inflation expectations were critical to our success in bringing down inflation without a sharp increase in unemployment. Anchored expectations promote the return of inflation to target when adverse shocks drive inflation higher and limit the risk of deflation when the economy weakens. Further, they allow monetary policy to support maximum employment in economic downturns without compromising price stability. Our revised statement emphasizes our commitment to act forcefully to ensure that longer-term inflation expectations remain well anchored to the benefit of both sides of our dual mandate. It also notes that price stability is essential for a sound and stable economy and supports the well-being of all Americans. This theme came through loud and clear at our Fed Listens events. The past 5 years have been a painful reminder of the hardship that high inflation imposes, especially on those least able to meet the higher costs of necessities. Third, our 2020 statement said that we would mitigate shortfalls rather than deviations from maximum employment. The use of shortfalls reflected the insight that our real-time assessments of the natural rate of unemployment, and hence of maximum employment, are highly uncertain. The later years of the post-global financial crisis recovery featured employment running for an extended period above mainstream estimates of its sustainable level, along with inflation running persistently below our 2% target. In the absence of inflationary pressures, it might not be necessary to tighten policy based solely on uncertain real-time estimates of the natural rate of unemployment. We still have that view, but our use of the term shortfalls was not always interpreted as intended, raising communications challenges. In particular, the use of shortfalls was not intended as a commitment to permanently forswear preemption or to ignore labor market tightness. Accordingly, we removed shortfalls from our statement. Instead, the revised document now states more precisely that the committee recognizes that employment may run at times above real-time assessments of maximum employment without necessarily creating risks to price stability. Of course, preemptive action would likely be warranted if tightness in the labor market or other factors pose risks to price stability. The revised statement also notes that maximum employment is the highest level of employment that can be achieved on a sustained basis in a context of price stability. This focus on promoting a strong labor market underscores the principle that durably achieving maximum employment fosters broad-based economic opportunities and benefits for all Americans. The feedback we received at Fed Listens events reinforced the value of a strong labor market for American households, employers, and communities. Fourth, consistent with the removal of shortfalls, we made changes to clarify our approach in periods where our employment and inflation objectives are not complementary. In those circumstances, we will follow a balanced approach in promoting them. The revised statement now more closely aligns with the original 2012 language. We take into account the extent of departures from our goals and the potentially different time horizons over which each is projected to return to a level consistent with our dual mandate. These principles guide our policy decisions today, as they did in the 2022 to 24 period, when the departure from our 2% inflation target was the overriding concern. In addition to these changes, there is a great deal of continuity with past statements. The document continues to explain how we interpret the mandate Congress has given us and describes the policy framework that we believe will best promote maximum employment and price stability. We continue to believe that monetary policy must be forward-looking and consider the lags in its effects on the economy. For this reason, our policy actions depend on the economic outlook and the balance of risks to that outlook. We continue to believe that setting a numerical goal for employment is unwise because the maximum level of employment is not directly measurable and changes over time for reasons unrelated to monetary policy. We also continue to view a longer run inflation rate of 2% as most consistent with our dual mandate goals. We believe that our commitment to this target is a key factor, helping keep longer term inflation expectations well anchored. Experience has shown that 2% inflation is low enough to ensure that inflation is not a concern in household and business decision making, while also providing a central bank with some policy flexibility to provide accommodation during economic downturns. Finally, the revised consensus statement retained our commitment to conduct a public review roughly every 5 years. There's nothing magic about the 5-year pace. That frequency allows policymakers to reassess structural features of the economy and to engage with the public, practitioners, and academics on the performance of our framework. It is also consistent with several global peers. To wrap up, I want to thank President Schmid and all of his great Kansas City staff who work so diligently to host this outstanding event annually, counting a couple of virtual appearances during the pandemic. This is the 8th time I've had the honor to speak from this podium. Each year, this symposium offers the opportunity for Fed leaders to hear ideas from leading economic thinkers and focus on the challenges we face. The Kansas City Fed was very wise to lure Chair Volcker here to this national park more than 40 years ago, and I am so proud to be part of that tradition. Thank you very much.
Thank you very much. We'll move into the presentations. So I want to allow a minute for all of the members of the press to go.
All right, well, that was Powell's speech. We'll get that out of here now. But wow, what a move, you guys. I mean, if you pull up the SPY here, well, let's just ask our good old sidekick here. I said into the chat right now, I'm going to. It sounds like Powell is basically confirming rate cuts for the FOMC rate decision next month and asking, what does this mean for the market and how are the markets reacting now since he started talking at 10 a.m. Eastern? And as you can see here on our polymarket indicator, the odds of a rate cut just absolutely jumped up basically to 100%. It's at, well, 83% right now. And the no change decreased from, yeah, it's like 11%. So the market is basically fully pricing in a rate cut of 25 basis points in September now after Powell's speech. So let's see what Sidekick has to say about that. I'm actually curious about TLT. TLT moved up pretty good, but it looks like, according to Sidekick and from what I saw, IWM was leading the move. So small caps were leading, which makes sense. Small caps do love a rate cut, followed by QQQ, which is basically big tech. So we got NVIDIA up like 1.7%. We got Tesla up nearly 3%. Palantir up nearly 3%. Coin was up like 5%, which is a little bit interesting. Don't think he mentioned much about crypto, but yeah, Coin had a really good move. And let's see what Sidekick has to say now that Powell is done. It looks like, well, at least TLT is coming down. Let's take a look at IWM since that is the biggest mover. IWM is not slowing down whatsoever. Well, I mean, a little bit, but pull up SPY. So is SPY. So the market's absolutely loved what Powell was just saying right now. Here's the market reaction from Sidekick. I mean, this tool is so awesome, you guys. Like, you really don't have to do anything anymore. You at least got to just ask Sidekick what you want to see. So obviously SPY's up, Q's up, IWM up. Bonds up a little bit, nothing crazy. VIX down 9.4%. Not surprising, but that's always cool to see. Let's pull up Bitcoin. That's a good idea because coin was moving up pretty good. Yeah, Bitcoin went from about 112,000. It's up like 2.4%. So Bitcoin is up there moving with small caps for sure. Which is always good. Always good to see. Let's see what Powell's rate cut confirmation means. So, yeah, of course, lower rates make future earnings more valuable. Small caps leading makes sense. Let's see, bond rally. There was a little bit of a bond rally. Risk on environment. Interesting. And this is actually saying, which makes a ton of sense, is REITs. Almost forgot about. I don't. I have some REITs, in the long-term portfolio. I don't really usually look at them, but if you look at O, really didn't move up that much. This is O Realty Income. I don't hold on, which REITs, maybe like VNQ. VNQ actually went up a whole lot. Wow. It looks like, wow. VNQ, the REIT from Vanguard, is up pretty good, actually, like 2% there. That's good to see. I think XLRE is the sector ETF. Let's see what this thing is up. Yeah, so REITs had a very strong reaction to that, which is not surprising. I mean, they're still like doing okay. Real estate hasn't been the greatest lately, but that is something interesting to watch out for sure. SPY bounced right off the 21-day EMA on the daily. Very nice move today. Who is out there that was in some calls or something? I know someone said their calls moved up like 400%. Love to see that. Monday stocks will be higher. I mean, we'll see. Stocks are higher right now, honest guy. So I don't know. We'll see if it holds. Good chance the momentum continues. I mean, really, SPY never broke its downtrend, as you can see right here on my daily chart. I think there is like a uptrend line somewhere here. Yeah, we bounced perfectly off that trend line. I mean, we did have a little bit of a downtick, here. That was the last, I believe, FOMC meeting. Then we had a little bit pullback there. But really, guys, it was really just pretty mild pullbacks. Yeah, bounced right up there. Need higher for break even on what, man? Brad. Let's see. What else is going to be doing good here? Potential risk, inflation concerns. It's saying if cuts are too aggressive. Oh, SPY. Yeah. Let's see. Let's pull up the 5-minute here on SPY. I mean, wow, SPY's near an all-time high. Higher for break even. I mean, if you need higher for break even, I'm not sure. I mean, you just buy all-time highs or what? Let's see. Dollar decline, asset bubbles, economic weakness signal. Yeah. I get you. Oh, that's good. That is good. What else is everybody else in out there? I mean, rate cuts are just steady declining right now. Let's see. This is our recent power gap scan. OUST is on here. Interesting. That one's actually not moving a whole lot today. Let's check out healthcare. Is healthcare ripping? UNH is looking pretty good. I think we can turn off our poly market indicator now at this point because Powell essentially just confirmed a rate cut for next month, which is honestly kind of surprising. He's usually not super forward about that, but you never know. Could change. Could change. NVO, another big sell-off in the healthcare market, starting to fill the gap today. Get NVO right here. Starting to fill in that gap. Love to see it for healthcare. XLV is the healthcare ETF. Broke out of its base. Yeah, it's looking pretty good if you bought the dip in healthcare. MRK, this one I've been watching. Look at MRK, you guys. This one honestly looks solid. I've been using Sidekick a lot. I'm actually going to be live here for a webinar in basically an hour at this, like an hour and a half, showing off Sidekick. So be sure to tune back in for that. We're going to be using Sidekick a little bit to check out the healthcare sector. And let me tell you, I did not think about MRK at all as a trade until I use these prompts on Sidekick that I'm going to be showing you guys later on in about an hour and a half. So definitely tune into that. And by the way, the TrendSpider Labor Day sale is live. So if you aren't a TrendSpider member yet, or you want to try out Sidekick here, you can do so now for just $5 using the link I just posted, and that's scrolling across your screen right now. Our Labor Day sale is live. So definitely be sure to take advantage of that because honestly, it's $5. I don't know why you wouldn't. Let me show you guys real quick. Labor Day sale just launched today, like last night, technically at 12 a.m. And again, $5 to try it for 14 days. It's basically free, you guys. Not free. It's $5, but you know what I mean. Anyway, look at MRK. This is a pretty, let me pull up the reports tab here, new column. Yeah, I mean, revenue, the last two revenue reports have been but again, it's hitting these support levels down here. Sidekick showed, pretty stable revenue. It did, get a negative surprise, a negative change percent the last couple of reports, but looking pretty solid. And so is LLY. It was one of the Sidekick top picks as well. And as you can see, it's doing pretty well from the bottom. Actually had a nice gap there on earnings to the downside, and that is currently filling as we speak. And LLY revenue and EPS has been beating pretty good. I think it was also looking at ABT as a potential one, Abbott Labs. So yeah, healthcare. Is anyone out there in healthcare stocks? Curious to see what you guys are in. I mean, UNH, if you are, it's looking pretty good. I mean, some pretty steep discounts there on the market. Obviously, UNH hasn't been super hot EPS wise, but revenue wise, it's been pretty good. So we'll see. We'll see what happens there. But honestly, let's check out the SPY 5 minutes, see how markets have been doing. Still ripping, pretty much about to hit a new high of day, about to hit an all-time high. As Brad said, just a couple more points to break even. Oh, that's good. Let's see. I mean, look at that. That's a beautiful, in hindsight, this is just a beautiful buy the dip opportunity right off the trend line, you guys. I mean, come on, just draw a couple lines on your chart and make some money. So what's going to happen on September 1st, since Powell said about rate cuts today already? Let's say September 1st, 17th. I think the next FOMC interest rate decision, let me pull up the calendar real quick. I think it's like the 17th. Hold on, don't quote me. So yeah, it's September 16th and 17th. So that's when the official rate decision is going to come in. Yes, IWM is amazing. Yeah, I'm not sure what you mean by September 1st. If you mean like the 16th or 17th, then there's a good chance they cut rates. Very good chance they cut rates. Wow, look at IWM. Is that all-time high? I always forget if that's all-time high or not. Yeah, IWM is looking very good. trying to push to this kind of double top it made here, these wicks at 244. Yeah, so basically, honest guy, probably going to cut the rates. And then honestly, it could be a sell the news event at this point because the markets is clearly pricing in a rate cut right now. And then, as they do the rate cut, maybe a sell the news event occurs, which means who knows, maybe the stocks come down, maybe the stocks rip and rally up until then, because the markets are generally forward looking. Right now, they're clearly pricing in a rate cut. Stocks are about to hit all-time highs, or at least the SPY is. And so who knows, maybe once the rate cut actually does come around, we get a sell the news event. But there is no telling. We'll have to wait and see. I mean, there's like, let's pull up the poly market again. There's pretty much a, wait a minute. Why does that look different now? DIA all-time high. Wow, look at that. Look at that. I'm not sure what happened to this poly market indicator, but it was ripping up last time I saw. Unless I just need another espresso in me, but I could have swore we were at 80% a second ago. It might be. Let's try switching it back and forth here. Fed decision in September. Let me check out a different one. I think how many Fed rate cuts in 2025? Yeah. Markets clearly pricing in 250 basis points, 37%, at least one. If we add those two up, we're at least getting a rate cut here in 2025. But look at that DIA all-time high. Technically the strongest index as it reaches all-time highs, because SPY and QQQ are not, which is sort of a risk-off kind of statement there, even though the QQQ and Bitcoin, all these risk-on assets are also rising, which is interesting. Well, not really, but it kind of is. Let's see, Fed decision in September. Let's go back here. Interesting. I must just need another espresso because I thought that number was ripping up a second ago. Oh, let's see. What's Palantir doing? Everyone's favorite stonk. It's on a dip right now. Yeah. Looking pretty good. Pretty good bounce from the bottom there. I'm not going to measure it from I guess we can measure it from the wick. Up 10% from that wick down, almost 11%. So congrats if you hung in there or maybe sold at the top of Palantir and bought this dip, because you are sitting pretty. I mean, if you bought anything, basically you're sitting pretty right now. Let's check out, I never pull up VXX on these streams, but yeah, this is volatility, basically how you trade the VIX. And VXX is steady decreasing. Let's see how much you could have made shorting this guy today. About 5% to the downside. Let's see. Let's pull up this power gap scanner, because these stocks theoretically, UNH is on the power gap scan. Yeah, they did have a gap up when Buffett bought. Let's see. CC is up 8%. Wow, look at this one. Where even is the power gap? There's a gap there. Not even sure what that is. Dox. Is this? Oh, Doximity. Oh, this one's looking pretty nice. Making these higher lows there. What did Sidekick have to say here? Yeah, we already read this. Let's ask Sidekick one more thing before we go. Is there anything anybody wants to ask Sidekick? I already asked it. Told it sounds like Powell is basically confirming rate cuts for FOMC. Asked what this means for the market and how they're reacting now. Obviously, it means, from what it said, is growth in tech companies going to rip. REITs are going to rip, which already happened. Current risk on sentiment shows small caps leading, of course. Growth outperforming value, but at the same time, DIA is making all-time highs. How much is it up, though, from the bottom is the question. Probably not as much. It's up pretty good, 1.3% compared to, let's go to QQQ. Qs are up 1.6%, and definitely IWM is leading. Wow, up almost 3% on IWM. That is a beautiful, beautiful time if you're a small cap investor right now. Let's see what else we got. TJX had a big, big power earnings gap, it looks like here. Not looking super hot today, though, compared to the rest of the market, at least. UNH still looking pretty good. It's always a good one. Let's see. Let's put a... Based on... Let's ask this. Based on Powell's... was it Jackson Hole speech that started at 10 a.m. Eastern today and is now over, where he essentially confirmed rate cuts for next month. What are some good YOLO swing trades? And I'm going to ask this. If you didn't know, TrendSpider Sidekick has a couple of different personalities. I've been using the Wall Street Dominator a little bit. This guy's great for just looking for kind of high risk, high reward plays. So I'm just going to ask, what's a good YOLO swing trade from these rate cuts? And let's see what this guy has to say. He usually has some pretty good insight, I'm not going to lie. The Wall Street Dominator, he's essentially going to respond as if a guy on, obviously, the Wall Street Bets on Reddit would respond. Definitely uses some choice words, but he does honestly have some pretty fun insights usually. So let's see what he has to say about some YOLO swing trades, because that's what everyone wants here, right? The data is spicy today. Let's see. He goes immediately. You don't even have to ask him. Usually I actually do ask him unusual options activity questions, but he went straight for it. He said AMD 170. Look at, he's going straight for the calls expiring tomorrow. That's actually hilarious. Yeah, I don't think I'm going to be buying 170 calls for tomorrow, but damn. I mean, AMD is rallying. I guess not the worst move, but it's not something I would be doing. Let's see. TXN 210 calls for November. At least this one has got a couple months. What is this? Texas Instruments. That's an interesting. I just literally asked them just good YOLO swing trades. And this is just what he pulled up. Various plays ranging from usual options activity from 87K to 137K. Like he said, IWM small cap calls. That's an interesting one. That's actually not a bad one as they approach all-time highs there. I mean, it's going to be hard to stop that momentum, I guess. And I guess there's multiple big bets on the Russell 2000 rally. TLT 83 half calls. I love that one. Look at that. Look at TLT, you guys. That's honestly a great. I don't know if I'd buy calls. Maybe you buy some leaps. He says 83 half calls. That's in the money. Might as well just buy equity at that point if you have the cash. But yeah, if you wanted a YOLO play, go for it. GLD calls. Wow. Look at this. Look at that's GL. I even looked at gold today. Gold actually, everything ripped today. Even gold ripped on those rate cut. That rate cut confirmation basically from Powell. If you're in my live like a day or two ago, we were actually taking a look at gold. Let me see if I can find the chat. Maybe, I don't know. We've been doing a lot of chats because this tool is awesome. But it did say rate cuts are bullish for gold. I'm thinking maybe it was this one. Yeah, it was this one. So look at this. This was a couple days ago. This is on August 20th. I was asking Sidekick for a gold analysis. And I believe it said, yeah, central bank demand. Investor sentiment. Yeah, it says upcoming Fed decision in September will be crucial. It says a rate cut would likely be bullish for gold. And look at that. Powell came out and was like, look, we're probably cutting rates in September, and gold absolutely rips. So that is interesting. I guess you could say Sidekick called that one. Sidekick called that one. That's pretty nice. Let's go back here. Was this the YOLO play? Yes, this is the Redditor. What else did he say here? So basically, he said IWM calls AMD, TXN, and NVIDIA. Massive unusual options activity today, apparently. Gold calls, inflation hedge plus rate cut combo. I mean, yeah. At this point, we might see a breakout from this base finally on GLD here. Not really an uptrend line there, but yeah, no, that's a pretty solid call outs from there. Insiders buying big on ASAN, apparently, they say as well. Let's take a look at that. It looks like the CEO, Dustin, dropped 3.1 million on his stock. Oh, Taylor Green by NVO. That's a good one too. Let's check out ASAN, ASAN, insider buying activity. Let's add a feed here. Insider trades. That's above 5 million. You don't need that. I just want to look at symbol ASAN. Wow, lots of buys. Look at that. Yeah, that is crazy. The CEO of ASAN has been relentlessly buying a lot of stock. Wow. Look at that, you guys. He's been buying ever since August 4th. If we go ahead and use our insider trades on chart indicator, we'll be able to see all of these buys. That's probably all the CEO. That's kind of insane. Making me want to get in here. Look how low the stock is. Look at that. So now I'm curious. Wow, ASAN does have the CEO buying quite a bit of stock. Do a deep dive in the fundamentals of this, if I can spell, of this company. You guys, honestly, Sidekick is so awesome for research. Like, I don't think I'll ever do actual research again other than prompting this guy. Do a deep dive in the fundamentals of this company. Tell me the best price ranges to buy in and give a bull and bear case scenario. So this is what I did. I asked the Wall Street Bets guy, the Redditor, best swing trades for a YOLO based on these rate cut confirmations. And then he gave me some pretty good calls. And he also found this ASAN or CEO Dustin Moskowitz or whatever was, buying a ton of it. I confirmed that in our What's Happening Now. And now I'm kind of interested in ASAN myself. So I'm asking it to do a deep dive into the stock, give a bull and bear case scenario into the, the fundamentals, tell me the best price ranges to buy in, and let's see what it has to say. Again, you guys, I will be live in basically an hour from now, an hour and 10 minutes, doing a live webinar on this Sidekick. So definitely tune into that. This will probably be my last chat here until I head off, get prepared for that. All right, let's go ahead and take a look. So obviously insider buying insanity, fundamental deep dive. Honestly, this analysis probably would have been better not with the YOLO guy, with someone like Warren or even Simon. But this works. Business model's actually pretty solid. It's funny. Let's see. Competing with Monday, Notion. Okay, interesting. 169K plus paying customers. Nearly half international revenue. That's interesting. 96% retention rate. That's pretty cool. Best price ranges to buy. Current price is $14.40. Strong support at 11 to 13-ish. Let's take a look. Yeah, that is correct. 11 to 13. Pretty solid. Resistance zone is 18. That's saying. Yeah, there's the resistance there. That's correct. YOLO entry, any dip below 1350, safer entry, wait for pullback to the 12 to 13 range if it comes. Let's go ahead and zoom into the daily a little bit here. We'll see. It's just made a second, technically a higher low. So if we get a pullback into that range, would be cool, but we'll see if we do or not. Did bounce already twice, kind of made of a double bottom there. Let's see. So bull case, why we moon. Says rate cuts, growth stock revival. Wow, the PE is 14 apparently. Let's take a look there. Oh, negative 14. Yeah, never mind. It's not profitable. Yeah, AI integration launching with ASAN AI Studio. Have AI integration, always a good sign in this environment. Did you do international growth? Sticky business, bear case. Yeah, still losing money is obviously one of the bear cases here. Looks like that. Look at that operating margin improvement though, going straight up. 5.1x price to sales, not great, but also not the worst, especially for a non-profitable company. Free cash flow negative, not great. So, it's definitely a high risk, high reward play. Yeah, risk on growth play for sure. And with the CEO literally putting his money where his mouth is with, all these purchases, definitely means something. And this is the same way for a dip below 12 to 13 for better risk to reward, or you can do a small position at current levels. So this is a pretty good analysis, not going to lie here. Look at that. Operating margin improvement is increasing. So yeah, that was a pretty good analysis, I think, from the Wall Street Bets guy. Obviously, the chart looks pretty terrible right now, but that is definitely some very interesting insider buying. Maybe just go ahead and watch this trend line right there to break up, and we'll see if it breaks out from there. But it does definitely have probably quite a bit of resistance if we look at the volume by price. Let's go ahead and do this to visible range. Yeah, so I mean, tons of people are in here. It could easily just get chopped around for a while, but it is a solid opportunity, I think. At least something to keep on your radar. But I think that's going to do it for this stream, you guys. Powell is done speaking. He already told us the rate cuts are basically happening. Again, join us again live here in about an hour. Well, I'll be live again doing a webinar for our new Sidekick. It's going to be a good one. And yeah, if you guys aren't TrendSpider traders yet, use the link that I just dropped in the chat to sign up. For just $5, take a trial of the platform. You can go ahead and follow along with the live webinar here in about an hour. And yeah, you get like 10 free messages on Sidekick when you do so. So you can sign up now, and then once the webinar comes around later, you can learn how to use it with us. All right. So with that being said, I'll catch you guys in about an hour. See you later, Monkey Man. See you later, everybody.